Glad to know you're still with us. But of course, I am not alone. I'm joined here by Frank Fagbo. Frank, thank you for being a part of this.
Thank you, Perpetua.
I mean, it's always a pleasure co-anchoring with you.
Amazing.
All right. Nigeria's government plans to issue 150 billion naira in bonds to fund infrastructure and manage rising debt. However, macroeconomic instability, including inflation and currency volatility, may deter investors. The government hopes competitive yields will attract domestic and foreign buyers. Meanwhile, the U.S. Federal Reserve's rate cut could boost Nigeria's economy by attracting foreign investment. Yet, addressing structural economic issues remains crucial for fully benefiting from increased capital inflows. Ambrose Udeaba, head of Securities Trading, Planet Capital Limited, joins us for this. Thank you for joining us today.
Thank you, Perpetua.
Thank you for joining us today, Ambrose. Okay,
Sorry,
the first question.
thank you, Perpetua. Can you hear me?
We can barely hear you, but can you hear me now?
Yes, I can hear you.
Okay. So how will the federal government plan to raise 150 billion naira through the bond market in September of 2024? How will this impact Nigeria's fiscal stability? And what should investors expect in the first term of yields?
Okay, thank you. So, bond issuers for the federal government of Nigeria is exercise, quarterly exercise, okay? They have calendar for that. And like you rightly said, the September bond issuance in the tune of 150 billion naira, which will happen next Monday, 23rd of this month. Looking at bond issuances and economic stability, I think also that bond issuances will always help government to finance budget deficit, support public spending, and also help in economic growth. Refinancing debt also is there. Long-term financing also, okay, which will also help the government, reduce reliance in short-term borrowing. So for this bond issuance, and then looking at how the economy so far has been performing, I think it's also going to help, okay, in supporting the budget deficit financing, and then supporting public spending, and also enable the economic growth vis-a-vis the little wins so far, okay, the GDP that was released in the positive also, and then inflation tending down. Okay, so I think it's a good one. And then for the investors, I will also think for the investors that what investors will also look at it is the yield. Usually the yield from the federal government bonds is usually attractive, and also it helps for diversification, okay, for the investors. And then it's also liquid. We all know that this bond will be listed and also will also be tradable. But for the fact of inflation, we also know, like I said before, inflation, of course, is tending low, is gradually dropping, which will also be a good one for the investors to take. And then looking at the general yield also, with the yield, the current bond is being offered now, okay, 19.3% for that of 5 years. That's maturing in 2029, 18.5% for that of 7 years maturing in 2031, and then that of 19.89% for the 9 years maturing in 2023. I think also that the yield, looking at the general yield for bond presently, and then in recent time, the yield is also attractive. And then considering the other incentives that comes with it, of course, we also know that they also qualify as securities, and they're also tax exempt. Okay, so for the investors, I think it's a thing to watch out. However, I would also advise investors again, okay, so while doing this, they should also do it in a way of diversifying their portfolio, monitoring, also consistently monitoring the credit rating of the government, and then the possible economic indicators. that will also help them to adjust their investment strategy according to the market condition.
Let me
So
come
for
in
the
here.
investors, it's a good thing.
All right, let me come in here. I want us to sort of digress a bit here. Now, what does this mean for the private sector and their ability to raise funds in the capital market? I mean, there have been conversations around crowding out the private sector. What do you make of that?
So like you said, yes. So that possibility is there, but if the general economy recovers, okay, like I said before, that this bond is also helping in economic growth. Okay, so if the general economy grows, I think the private sectors also will equally benefit from it, in the sense that the general growth in the economy will affect all the key players and the investors in the economy. So yes, it may look as if it's crowding out, but looking at the little wins, which I also believe that the issuance of this bond will also help to increase these wins. And if this wins continues, the private sectors and other sectors will begin to benefit as the economy grows.
Okay, if you look at our debt profile, it's quite worrisome. With our debt profile, with the continuous reliance on bond issuers, such as the 150 billion naira target, would this have a long-term adverse effect on the economy, or is it just necessary? Is it a necessary step for development as well?
So yeah, so the long-term effect, adverse effect on the economy, development, and as the case may be, is also depends on the government, who is the issuer of this bond, how they're able to utilize this bond, and of course, the essence of the bond is a good one. If they plug it back and then deploy it successfully in the key sectors of the economy, and the economy recovers, it becomes a good thing. In doing that, the government should also ensure that they maintain prudent fiscal policies. Okay, for the fiscal policies is needed. They also have to monitor these debt levels and then the interest burden also, which is a key factor here. But I also think that if the government deploy these funds well and it helps in growing the economy, it's not going to be a cause for concern. Rather, it's going to be a good thing, for more bonds to come and then be subscribed successfully.
Well, that's on probability anyway. Let's shift gears now and get to something else. The U.S. Federal Reserve's retained 0.5% interest rate cut at 50 basis point holds some positive impacts for emerging markets like Nigeria. Is this a given considering the nation's current economic challenges?
So generally, it's a good one. It's also going to help investors to want to focus more on the emerging market. Okay, of course, we also know that once things like this happen, foreign investors will always focus on emerging markets, which in this case Nigeria is one of it. So I think that this will also bring potential increase.
I'm saying, considering the current, economic indicators that we have here in Nigeria, I mean, is it a given? Is it just going to happen because, I mean, this is what should happen? Are there some structural issues that we probably need to address so that this can be to our benefits?
Yes, so like you rightly said, I agree with you. But again, if you look at, like I said before, the recent time, okay, how the economy has been behaving. If you look at the GDP result that came out, if you also look at the inflation rate, okay, that comes out, and then if you also look at the general economy having recorded inflation dropping for 2 consecutive months, and then the GDP, okay. So I also think that then vis-a-vis other news, the issue of the local refinery, and then the issue of selling crude local currency around it. So I also think that these things are showing that, yes, the economy is recovering. These things are showing also, yes, there are little wins. And I also think that if you look at the rate part of it, okay, investors will always want a higher rate. And if you compare our own rate to what is obtainable there, I think the emerging market have it. So right. I'm positive that we are going to experience some inflow, okay, and then while the economy continues to improve, more inflows will begin to flow in.
All right. Thank you so much, Ambrose Udeaba, Head of Securities Trading. Planet Capital Limited, for your time and thoughts on market pause today.
Thank you.